Hello everyone, Dave Landry here from DaveLandry.com, and this is Trading Simplified. Wow, this is our 25th show. My producer Rachel said we'd do something special for the 25th show, but she's busy quarantining somewhere out in the West. So when she returns and we get through all of this mess, we'll do something special for you guys, I promise. So what are we going to talk about? Well, I want to continue to talk about surviving and prospering during a bear market with a focus on have we bottomed? And it's not easy. The easy part may be done with this leg low. We had a really nice sell-off and we got into a lot of shorts and they paid off nicely, but now it's a little bit more difficult. And I'm going to show you some discretionary techniques you can do to improve upon your performance. Housekeeping. I do take requests. It makes my job a lot easier when you tell me what you want to hear as opposed to me telling you what I think you need to hear. And we'll do a little bit of both, but feel free to send in your requests. If you need to find me, davelandry.com/contact. If you want the slides from this presentation and all of my presentations prior, access to a free market timing course, which has a lot of the things that I talk about in these slides, feel free to go to davelandry.com/StockCharts, put your information in, and you'll get a plethora of information, enough to keep you busy for a long time. And by the way, a lot of the signs and signals, for instance, that I'll talk about today are covered in a lot more detail in those prior presentations, including the rules. Now, before we get started, I've been saying this for the last few weeks, so let me just get through this quickly. I want to show you some things that are relative to this market, but will apply to future markets. In fact, a lot of today's slides, we go back and look at what happened in the past, and we looked at signals from the past. And this is just in case I get hit by a beer truck, or more likely my wife kills me while we're in quarantine. Now, somebody said something about hindsight, and I assume they might have been referring to a system that I was walking you guys through a few weeks ago. And this system's been out for 2 years, so you can't say that the last 2 year signals have been in hindsight. And also, a lot of stuff I'm showing you today, I've done 20 years ago. Some client recently told me that when he was doing his due diligence and doing some internet research and checking me out, he went back and found forums from over 20 years ago where I was talking about some of the concepts we're going to talk about today, such as bow tie. So if anything appears to be hindsight or pouring salt into the wounds, believe me, I'm not. But do use all of this as a learning example for next time. So it's a fluid situation. One thing that I've been doing on most days, or nearly every day, is a bear market update. You can go to that URL there, or if you just go to my website and look at the top menu, I've added a special item for that, and that's the bear market 2020 updates. And then also check the home page at davelandry.com. I guess the $64,000 question is, when will the market bottom? Well, let's take a look at prior tops and bottoms. Now, this is a weekly S&P. We obviously had the top in 2000. We had the bottom in 2002, 2003. It took a long time for the market to bottom then, and we'll talk about that in just one second. We had the top, obviously, in 2007, which was right before the big slide, obviously in 2008, 2009. And then, of course, we bottomed out then, and the market has had the mother of all rallies since. And now, once again, we're at a top, and we have a bit of a sell-off. Now, here's the thing. I guess everybody wants to know, is this a bottom? Well, it kind of looks like a bottom at a top. In other words, we really haven't gone down far enough and long enough, at least from the way I see it, for it to be a bottom just yet. And I'm going to flesh all that out in just 1 second. And by the way, a market can do whatever it wants to do, as I'll explain in a few minutes. So if we go back to the bear market of 2000, you can see that the market dropped for 2.5 years. And the green line in here, just FYI, is the 10% line. And that's 10% below the 50-week closing line. That's part of the TFM 10% system. And any indicator that I show you, I don't really use that many of them, but occasionally I'll use something, especially for teaching purposes. I am working with a programmer to bring them to you in StockCharts.com. And some of those are actually in beta testing, and they're really cool. I've been having a lot of fun playing with them, but hopefully we'll get them out as soon as possible. So the market did lose 50% in that bear market, and it was hitting 5-year plus lows before it finally did bottom out. Now, that bottom took well over a year to occur. It was more of a process than an event. Now, if we look at the bear market in 2007, 2008, you can see that the market went down for 1.5 years. It lost well over half of its value. And by the way, this is why I'm not a big fan of buy and hold, or as I like to call it, buy and hope, because occasionally the market and any other asset class for that matter will lose half of its value, which is fine as long as it doesn't lose half of its value right before you retire. So what's interesting about 2009 bear market is we were hitting 13-year plus lows before the market did finally bottom out. And that bottom, like the 2002, 2003 bottom, did take a little while, even though there was a bit of a spike towards the end of the bottom. So speaking of spikes, we did have the spike down in the S&P 500. We are hitting 3-year lows, which is pretty impressive. But I think we're going to have to hit some longer term lows, longer than 3 years, before a bottom will occur. But so far, we have rallied off of those lows. Unfortunately, though, we're just a few weeks off of the low and possibly a low. I don't think we're at the low just yet. But again, the market can do whatever it wants. Now, one thing that concerns me with this bottom at its top is these V-shaped recoveries at high levels are very hard to sustain. So what happens is the market makes this V-shaped recovery, if it does this. By the time the market gets all the way back up to the old highs, a lot of people are looking to get out at break even. And long before you even get there, should we get there, that would be great. But I think it'd be a dangerous time to buy. And then somewhere in between where we are now, or where we were at the lows, you have the widows, the orphans, the soon-to-be retirees looking to mitigate damage. In other words, some selling coming into the market, likely. And then here's where it gets even more complicated. There's leverage, derivatives, and a lot of liquidity unwinding. Now, that's really hard to quantify or impossible to quantify, but it's kind of in the back of my head as to some of the things that could deter this market from making that big old V-shaped recovery. So I think the point I'm trying to make is that it's complicated, and these things will take time to unwind. I really doubt that it's going to be just a big old do-over. That would be fine with me, though. I don't mind getting stopped out of my shorts and start going long again, because the long side is a little easier to play. I'm going to touch upon the short side being more difficult in just 1 second again this week. Now, with that said, let's not think too much. All these thoughts in the back of my head, but the reality is I believe that price is king, and I think my column on Monday was on just that. So you want to watch for signs and signals instead and pay careful attention to what's going on with price. Now, I'm not going to go through the details of the 10% system, but one point I've been making recently is that as a general statement, you want to be long above the 10% line and out or short below the 10% line. And borrowing the line of reasoning from Arthur Hill, who was quoting some other people, bad things happen below the 200-day moving average. So I thought about that, and it's like, well, bad things happen below the 10% line. You can see we've had some bear markets that occur, of course, in 2000 and in 2007 below the 10% line. We did have a few dips below the 10% line here and there. Now, I do have some additional whipsaw filters to help avoid some of these things, but you don't want to filter out everything, because that you can get into a lot of trouble if you do that. Too many rules in the system. So the system has very basic rules. Essentially, if you're more than 10% away from the 50-week closing high and you close below the 50-week moving average, that is a sell signal. But you can see we had a couple of dips below the 10% line. Now, the last dip we had was pretty serious, the one before the one we just had, obviously. Even though the market went right back up, I think if you held through that sell-off, it was a really bad idea. And that's where I met some people. I'm kind of a man on the street guy, and I bumped into somebody, and they're like, man, I traded, and I wish I would have bought more. I'm glad I held on. And it's like, okay, well, that'll work until it don't. And I think right now we're in one of those markets where it don't. And notice the big slide below the 10% line that we've had so far in here. And as you know, we recently had a sell signal. If you go in and look at the slides, or better yet, watch the recent YouTubes where we talk about this sell signal. Now, one thing I've been noticing, and that's the kind of the fun thing of, I know you probably want to party with me, but the fun thing about you come up with a little simple system to make a point, and my point with this little 10% TFM system was that simple systems can work in markets. And if you look at everything I do, it's really simple in nature. I've tried all that complex stuff, and you name anything in the world. And I bought a book called, I think it was the Encyclopedia of Stock Market Indicators, and I went through that book cover to cover, programmed and tested everything in that book. And then one day I realized that maybe I could just look at the price and keep it really, really simple, and occasionally use a moving average or something like a price indicator to show you where you are relative, such as this 10% line. So anyway, one thing I was thinking about in watching this system in real time over the last couple of years is just kind of learning how it acts. It's one thing to look at a bunch of little price bars and crunch some numbers in the past, but it's much different to actually watch it unfold in real time. And one thing that I noticed, if you take a look at like the 50-week closing high, you can see as long as the market is making new closing highs, the blue line here is going to work its way higher. And then obviously the green line is 10% below that line, but it's also going to follow the market higher. Now, the point I'm trying to get to about the TFM 10% system is that in order for this green line to drop, because we just made the 52-week high on a closing basis recently, it's going to take another 42 weeks for that line to begin dropping. So it's going to take a long time for this signal to trigger. If you go back and look at the slides from the 2000 bear market and the 2007 bear market, you'll see that because it took so long for the market to bottom, this green line began to work its way lower to give you a sell signal. So it's going to take time for that to work lower, or the other thing would be we'd have to have the mother of all recoveries, the V-shaped recovery that we talked about a minute ago, in order for that to trigger. Now, one thing you can watch is the daily bow tie, and the bow tie uses a 30-day exponential, a 20-day exponential, and a 10-day simple exponential. I've experimented with a plethora of moving averages over the years, and I find that these three moving averages work really well, and just having them in proper order, meaning the 10 is greater than the 20 and the 20 is greater than 30, or for downtrends, the 30 exponential is greater than the 20 exponential, and the 20 exponential is greater than the 10 simple, or if you prefer, the 10 simple is below the 20 exponential and the 20 exponential is below the 30. That could really help to keep you on the right side of the market. So I call that proper order, meaning that the faster moving averages, the ones with smaller time periods, or above the slower moving averages, the ones with longer time periods for uptrends, and vice versa for downtrends. So you can see that we did flip over from uptrend proper order to downtrend proper order. Now that happens after all-time highs. That makes what I call a bow tie. It's a little bit sloppy in this particular case. By sloppy, I mean it didn't cross over super, super tight. And if it does, it cross over on a really, really tight basis, let's say over 3 to 4 periods, it gives the appearance of a bow tie, and that's where that name comes from. Now, once we have a shift in trend, we're looking just for a simple little pullback, and you could see that you have a sell signal that triggered here. Actually, looking at this chart, you could actually take a more aggressive entry, and it technically did trigger on the prior day right around 3,000. But you get the idea. Now, could we have a bow tie from these lows? Absolutely. But ideally, I like to see it coming off of major lows. Now, we are coming off of 3-year lows, which I didn't really realize it was that much until I put together this presentation. So it is a fairly major low, but I like to see much, much, much longer lows, maybe a 5-year or even a 10-year low for me to get really excited about a daily bow tie signal. But nonetheless, we do and should pay attention to them. Now, you can see the moving averages are beginning to come together. One thing I learned from Greg Morris is that with an exponential moving average, as soon as price crosses above it, whether it's a 10-day exponential or a 100-day exponential or even a 1,000-day exponential, the average will turn up, and that's why the exponential moving averages turn up quickly in this bow tie situation. Now, I actually have a little bit of lag built in by using a 10-day simple. For short-term price movements, I prefer to see the actual average of price, and that's why I use a 10-day simple. But you can see the 10-day simple has turned, the 20-day exponential has turned up, that is, and we flatten out on the 30 exponential, but as soon as the market trades back above that level, it too will turn over. So it could turn up. So we could see these bow tie moving averages come together and go from downtrend proper order, which we're in now, back to uptrend proper order fairly soon. And you can see they are beginning to come together. Now, I've beat the dead horse with this in prior presentations. If you go in and watch the weekend charts, I think after about 10 or 12 weeks of doing this, somebody's like, okay, Dave, knock it off. We get it. But the weekly bow ties, just in case somebody here is not familiar with the weekend charts, I often show those weekly bow ties, and they have quite a bit of lag to them, but they can help to keep you on the right side of the market. Now, if a market gradually rolls over like it did in 2007, you'll actually get the signal long before the bear market occurs, which is pretty cool. Now, on a V-shaped bottom, like in 2009, there will be a little bit of lag, but you can see it did signal the start of a major bull market. Now, by the way, these signals, I like them off of major highs, ideally all-time highs, and major lows, ideally 5 or 10-year lows. And that's the point I'm trying to get to with the weekly bow ties. Now, we did have one back in 2015, and the market sold off pretty hard for that year and a half or so. Even though it wasn't spectacular like some of these other signals, I think it was significant enough to where you probably should have gotten out of the way. And if you didn't get out of the way on that signal, again, in 2019, there was a signal there that was pretty ugly. In fact, I think the Russell dropped about 18% from this signal, and the S&P dropped significantly from that signal too. It was easily into the double digits. So this is another case where I think holding on was a bad idea, and I think now is exhibit A of how holding on is a bad idea. Now, keep in mind, we could have that V-shaped recovery, and what's going to happen if that happens, and use this for future reference, is that these people, these buy and hold people, have learned absolutely nothing in the process. But I was a little surprised when I was putting together my slides this morning that we actually do have a weekly sell signal in the bow ties. So the moving averages have caught up fairly quickly to the market. Now, if we zoom that in, you can see that the moving averages have come together, and this is on a weekly basis, okay? By the way, what's kind of fascinating is go in and watch the last several presentations that I did for StockCharts.com, the Trading Simplified shows, and then also go to my website and look at the bear market updates. Go all the way back to late February, early March, where I started putting things out. What was amazing to me is we got a weekly sell signal on the TFM temper system before we even had the daily sell signals. Now, the daily sell signal happened during a retrace, the bow tie sell signal that is, and that was also up around 3,000. So it did catch up to the market fairly quickly. But anyway, it's the first time in history I've seen a weekly signal trigger before a daily signal. Now, when you see something odd like that happen, you need to ask yourself, what the hell is going on? Is this something different? Is this a really ugly market? And that's what scared me into telling friends and family to chill the freak out, because the market is saying this coronavirus, which is only a cold, could be something a little bit much bigger, and that's what kind of had me scared. But anyway, I digress about that. But you can see that we have pulled back a little bit, and that completes the sell signal. So if we take out this weekly bar low, let's say around 2,500 or so, 2,500 and change, then it could be a trip back down to the old lows, and that would be an ugly type of situation. And I do think we can return, or will return, to the old lows, as I've been preaching. I think it's going to be a very bumpy ride. And again, if you go back to 2019, we did have that sell signal, and the market did drop significantly from that. Remember, this is a weekly chart, and you were up at the 2,800s, and this thing dropped down to the 2,300s. That's a pretty big move in an overall index like the S&P 500. So is this the bottom In a word, no. But I think the market could do whatever it wants. Some of the things that the market did recently were unprecedented. A mortgage loan officer called me a while back, wanted to know what I thought about bonds and interest rates and all. We began a lengthy discussion, and I just kind of off the cuff said, "Well, what I'm seeing is unprecedented," and that really struck a chord with her. Like, okay, wow, this guy's been looking at markets for a long time. I've also, in my prior career, or part of my prior career, I should say, I consulted with a hedge fund that traded nothing but bond options for 14 years. So even going way back to then, I still haven't seen anything like this in my lifetime. So the move has been quite unprecedented, and the market could do whatever it wants. If you were to tell me that a weekly signal would trigger before daily, I wouldn't believe you. But now I have to believe in what I see and not in what I believe. And by the way, write that down when it comes to markets. Now, I don't want to confuse the issue with facts, but there's a lot of things that still have to unwind. And I think that's the underlying tone today, is that these things take time. I don't think it's going to be a big old do-over with the overall market. Now, time heals wounds, and I've used this example quite often. And as I was going through my slides right before I went live today, I got to thinking, wait a minute. I'm sitting here talking about death and estate settlement. Everybody's gonna think I'm just referring to COVID-19, but no, I'm referring to in general. Over time, you end up with a lot of supply that comes out of the market, or I guess supply that comes into the market, and these things work their way through the system. So people die, unfortunately, and then there's estate settlement, and it kind of brings me back to the Tom McClellan argument from his mother, Mary McClellan, that people buy and sell stocks for a variety of reasons. Some people buy when they have money, some people sell when they need money, and others use far more sophisticated methods. So there's a lot of things that happen over time to heal the wounds of a bear market. So again, some people might need money, especially in these kind of questionable times. Unemployment is skyrocketing, obviously, because a lot of us aren't fortunate enough to be able to work through this. And so there's some need money selling that's could happen. Retirement pressure, as I've been kind of picking on a buddy of mine. He picks on me too, by the way, so don't feel sorry for him. But he was at my house before this mess started. He's like, I'm making $1K per day in 401K, and he was like thinking, like, why am I wasting all this time with this troublesome day job when I'm making a fortune in my 401K and I should be able to retire real soon? Well, I think all of these players could put a little pressure on the market. And the other thing too is, as I've been saying lately, a family member recently had contacted me in a panic, and she has some health concerns and may not be able to return to work, and she's watching her retirement get decimated. So I think there's still some supply left to come to the market. Obviously you can't quantify that, but I think it's kind of good to kind of keep that in the back of your mind and factor it in. Now, over the past few weeks, I've been talking about the fact that shorting is a little bit harder than it looks. I mean, when it works, it's like butter, but a lot of times it's a really bumpy ride and doesn't work as good as it looks on paper. So here's a great example. We had a short set up in Uber, and by the way, this is one of the mystery charts that I showed before it triggered, and you could argue that, well, maybe it didn't work out so well. It hasn't really worked out so well just yet, but my point is, with a little discretion, you can really improve things. And this is especially true on the short side. So we had a nice little sell-off. Uber pulled back deeply, but I still thought I was in trouble. We had a sell here, and we sold short at this level here, and then a stop is up here. Now it triggered and then began to rally back up. And a lot of times, there's an old Wall Street adage, all shorts go against you, and that sure seems to be true. And you could see that it went up and barely nicked that stop at 28. Now, I held through this. In fact, I didn't even realize that it had stopped out because I don't put my stops in the market until after the open. And by that time, Uber had already began to implode a little bit. So you could see that it sold off nicely. And actually, your equity would have gone up by exercising just a little discretion. Now, I'm not saying throw caution to the wind, but if you come in and futures were up huge, you need to think about holding on to those shorts just for a little while, see if they begin to reverse, and if they do, then put your stop back in above the high of the day. So let's take a look at what that looks like. So Uber gaps open, and I track things mechanically in the model portfolio. And that's so nobody could say, oh, it's in hindsight or you're not following the system or whatever. But in my own personal trading, I will apply a little bit of discretion. And like I just said, I didn't even realize that Uber was above the stop right around the open. So you can see gaps higher, knocks that stop or nicks that stop, and then comes right back in. So that's a $2,000 loss per 100K. 2% is what we risk per trade if stopped out. But you can see it came right back in. Now, they won't always do this, so you will have to have an uncle point in mind. But as you can see, when they do work, it's like butter. So you could see you would have had about $1,000 swing in equity just by holding through that open as opposed to stopping out. Now, it's too early to start kissing each other just yet, but let's say that Uber does continue to sell off, then this loss, mechanical loss, would be improved, obviously, because you'd still be in the position. So there's still a chance that it could work. By the same token, the same exact thing happened in TJ Maxx. Mechanically, it did stop out. Now, this one I was focused on the open, and I did explain to my clients why I was going to hold through it vis-a-vis the Facebook group. And not that I was going to be obstinate. I did have a plan to exit it if it kept rallying, but it just kind of went up, barely nicked that stop, S-T-O-P, before it came back in, and came down nicely. And you could see holding through that little bit of a stock nick. Now, that is a little bit more risk, obviously, because and the other thing is, what if it keeps on going, okay? So you have to have an uncle point, but you can see how things have improved, in this case, quite greatly, I should say. And, of course, if it continues lower, then it could turn into a profitable trade from here. So shorting is a lot harder than it looks on paper. It's also good to apply a little bit of discretion, or the point I'm trying to make is discretion is very important, especially on the short side. As I said last week, there's some people that are just coming into the market now, and I was quoting Arthur Hill. It's kind of like, hey, I want to learn how to go sailing, or paraphrasing Arthur Hill sort of. And, there's a big hurricane out there, but let's just go out and see what happens. And some people that are contacting me or trading things that are kind of thin, shorting some thin things, they're also trading some leveraged and derivative type of instruments. So it's a complex world, so just be really careful if you're just coming into this. But here's the deal. It's a wonderful opportunity to learn, but you don't have to put your hard-earned bucks on the line. If you do put your money on the line during this bear market, just tread lightly. And then there's some people that are going to start trading options, and it's the same sort of going sailing in a hurricane type of thing. Be really, really careful. I don't trade personally off mechanical systems, but do pay attention for some of these objective signals. So if we get proper moving average proper order to the upside, he tried to say, then by all means, we might be bottoming out, at least temporarily. Now, here's the thing. Don't be afraid to ask for help and get educated. It could be a lonely sport. Believe me, it's kind of lonely being here by myself all day, and I've really been enjoying interacting with other traders vis-a-vis the Facebook group, which you do have to be a member of DaveLandry.com. You have to be a gold member for that. But anyway, it's been a godsend for me, and I've got a lot of good ideas on that. So, in summary, I don't think we're at a bottom just yet, but hold on. Obviously, honor your stops on any shorts. Apply a little discretion as needed. Don't throw caution to the wind, okay? And just give it some time. And if this is your first bear market, make sure you use this as a learning opportunity. If you need to reach me, again, DaveLandry.com/contact. And you could also go to DaveLandry.com/StockCharts for the slides and a plethora of other information. So thanks so much for watching. May the trend be with you. Everybody stay safe and sane.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.